Hi, this is Mike Frosch, and today we're here to talk about product warranty insurance. So, what exactly is product warranty insurance? Product warranty insurance is an insurance program that utilizes a contractual liability insurance policy to transfer risk from an original equipment manufacturer or a product seller to an insurance carrier. Product warranty insurance is used to help companies who are seeking options to offer a longer limited warranty on their product versus their normal limited warranty. Product warranty insurance can offer the OEM or the product seller balance sheet relief for the longer limited warranty period. These programs work extremely well in a couple different environments, including technology companies, where the OEM or the product seller wants to focus on the features and designs of the product and not on the warranty. Highly competitive industries where a longer limited warranty offers a competitive differentiator. If you're offering a 3-year warranty and your competitors are offering a 1-year warranty, you have an advantage. And subscription-oriented programs that wish to offer some type of a warranty, a limited warranty, as long as the consumer subscribes to the product or service. Those would be a few great examples. Product warranty insurance works in many different segments, including the consumer product segments. Consumer products include items such as appliances, electronics, Internet of Things, smart devices, connected devices, exercise equipment, sporting goods, jewelry and watches, musical instruments, and many other categories. Product warranty insurance also works within the automotive space, covering items such as automobiles, trucks, or the actual automotive parts, or any accessories for in the automotive space. In the marine space, product warranty insurance works well with boats, jet skis, trolling motors, fishing and depth finders, GPS, satellites, and a host of other accessory items. Within the power sports and the recreational vehicle segment of the market, product warranty insurance works extremely well with ATVs, motorcycles, snowmobiles, or RVs. An example of how to use product warranty insurance, here's a scenario where there's an OEM who wishes to sell a product in the United States and they want to offer a 5-year limited warranty. The OEM only wishes to back the limited warranty themselves for a 90-day period, and then they want to utilize a solution that provides a financial backing for the additional 4 years and 9 months of coverage. The OEM is provided as a solution with a product that covers the liability under the limited warranty after the initial retention period, which is the 90-day period, and then up to the 5 years from the original date of purchase. Product warranty insurance in this scenario picks up at 91 days and goes all the way out through 5 years. So in the end, the consumer sees a 5-year warranty on their product. In this example, it's 5 years parts and 5 years labor, with the OEM retaining 90 days labor and 90 days parts, and they're underwriting the balance of 4 years, 9 additional months, utilizing product warranty insurance. The benefits of using product warranty insurance include balance sheet relief with a one-time predefined cost. The OEM or the product seller knows what the cost is for the warranty, and they can pay the cost and not have any longer-term liability on their balance sheet. They can purchase coverages up to 10 years. So an item could be anywhere from a 90-day or a monthly all the way up to 10 years of coverage is available. But that depends greatly upon what the product type is and how the product is used. And it's a fully backed solution. The obligations of that extended period, the non-retained period, are underwritten typically by a contractual liability insurance policy. When you get into the claims administration side of product warranty insurance, there are a couple different ways of doing it, but the traditional basic customer experience example that's shown here is exactly how an OEM operates today. The unit fails, the customer contacts the OEM does a validation process, maybe they offer some technical support. They may dispatch a servicer to the customer's site on home or office. The unit could be shipped in for repair, or the OEM could simply offer a replacement for the product. Those are all various options that exist, and in the end, the OEM is able to submit claims during the covered period to the carrier for reimbursement. Pretty simple process there. The four elements are the OEM or the product seller, the limited warranty, which is the document that outlines exactly what the customer is receiving. The limited warranty, we've all seen it. It's packed inside the box when you buy a new item, and it explains to the consumer what is covered. There's the retention period, which we've talked about before, how much is retained by the OEM from the period of time, and that can vary. And then, like I said, lastly is the customer experience options, and it can vary from the example that's listed here. In some cases, an OEM may outsource some or all of their administration, whether it's in the retained period or during the extended period as well. In summary, product warranty insurance is a highly configurable solution that is based on several factors. The factors include the length of the entire limited warranty. So it could be for our monthly program, again, all the way up to 10 years. The condition of the limited warranty. What's being covered? Is it parts only, parts, labor, tech support? Is it on-site? Is it in-home? Those are all factors that contribute to how to build a solution. The length of the retention period that the OEM and the product seller will retain. Are they retaining 30 days, 90 days, 1 year, 2 years? It can vary on a product-by-product basis. The review of the type of product, the manufacturing and performance data of the product. What's the failure rates today during the original OEM warranty? And that can be extrapolated out to project what that would be for an extended period of taking a 1 year, 2 or 3 year as an example. Looking at the data that exists for the 1 year period or similar data, and then extrapolating out what the expected failure rates would be beyond that, and then coming up with a program. A review of the service and the administration process is very important. Who does the customer care, the admin? How is it managed? How is it being performed? And then finally, you create and determine a cost. What is the cost for the 4 years, 9 months, as in the previous example? What would that actually cost, and how does that apply to a per unit basis? Then you determine the sales registration and the claim submission process. Typically, it's done on a monthly basis, where an OEM will submit on a monthly basis products that are built and shipped, and then on a monthly basis, they'll submit claims back to the carrier. Options do exist on how coverage is provided and structured. This presentation today is really an example only, and each opportunity needs to be individually reviewed to determine if a solution is viable and what that solution would look like. We're not offering any coverages today. We're not guaranteeing anything. There's no binding based on this material. This is informational only. And we're also not offering you any legal advice, accounting advice, or making any other commitments. We would suggest you speak with your legal counsel or your financial department to get more information on how it would impact you. If you have any additional questions or you want to understand how you might be able to implement a program, please contact me. My email is mike@personalsafeguards.com. Website is personalsafeguardsgroup.com. And look forward to hearing from you. Thank you.